What's up, everyone? In this video, we have some very important things to talk about. The market's been crazy in 2022, but it's only going to get crazier going forward. In this video, we're going to look at some very cool charts and some very important information that you need to know about going forward. Some of the data that we're going to be talking about today has not happened in over 40 years. So today's video is important. Make sure to stick with me towards the end because there's a lot of important things you need to know going forward. But let's get right into today's video. So looking at the S&P 500, we can see it's been in a continuous downtrend all of 2022. We've basically been stuck in this downwards channel all year long. We've had multiple tough rejections at resistance, you could say 4 times, and it's just been very, very consistent, right? At the same time, we've also seen a lot of support bounces off of this lower support level that have also been pretty consistent. But now we might have things that are going to change this whole system. So basically what we need to know is, we'll start with the first data point, which is S5TH. This essentially represents the percentage of stocks that are above their 200-day moving average. This has been a very consistent data source in the past with helping gauge how the market's doing in terms of just multiple stocks overall. So let me explain a little bit further. Not all stocks in the S&P 500 are created equally. As we can see in the heat map, we have some companies like Apple or Amazon or Google or Microsoft that have a much, I guess you could say, heavier weighting or a much stronger influence on the market overall compared to a company like, let's say, General Electric, right? Not all companies are created equally. So sometimes what we see in the stock market is we have a lot of stocks falling, but we have a couple of the more powerful stocks like Amazon, Tesla, Apple, Microsoft, and Google actually holding up. So sometimes we get a point where a lot of stocks are falling, but the S&P 500 itself isn't falling that much because the powerhouse stocks are holding it higher. That's why S5TH is important, because it shows you a nice overview of how all of these stocks in the S&P 500 are doing. So like I said, it represents the percentage of stocks above their 200-day moving average, and this is important because basically all throughout history, this data point constantly fluctuates between 90 and 10. When it's at 90, it means 90% of stocks in the S&P 500 are above their 200-day moving average. That shows that just all stocks are ripping, right? At the same time, when we get down to that 10 mark, right, that means that basically all stocks are in a downtrend and there's a lot of selling pressure. It's important to keep this in mind because if we add the S&P 500 to this chart, you will see how consistent this data source has been in the past, especially when it gets below that 10 level. So let's see. If we go back throughout history and we see the last time this data point was below 10, it was on October, you could say September 28th, we'll say, right? That ended up being an amazing bottom for the S&P 500. Again, it was right around 10 on June 17th. Guess what? Another solid bottom. At least a temporary bottom, right? If we go back to another crucial point that this data source was below 10, that would be in March of 2020. Another amazing buying point. If we go back even further, we could see we had it below 10 another time in December of 2018. Another amazing buying point. Basically, this orange line that represents the S&P 500, and I'm just connecting the dots every time S5TH is at or below 10, and it ends up being a great buying point every single time. Even if we go all the way back to 2011, we had another amazing buying point right in September of 2011. We had another signal in 2009. It's very, very consistent, and that's why I like to look at this data metric because it works, and it's nothing overly complex, but it works and it's simple and it's reliable. So that's why I always like to check in on this, because it works, right? And I don't want to make anything more complicated than it has to be. But now we can see we have around 57% of stocks in the S&P 500 above their 200-day moving average. we're at like that middle point right now, like right around 50%. So like the stock market is like kind of uptrending, like some stocks are uptrending, some aren't. So it's like we're at this middle point right now, and it's more of like a standstill than anything else. When we look at that S&P 500, we're still very close to that upper resistance level, and we do have a couple important things coming up over the next couple weeks in the market. So basically what's going on in terms of like behind the scenes for the market, we are in a giant fight against inflation, and we have been all year long. The inflation we've been seeing over the past year especially is unsustainable, and if it stays elevated for extended periods of time, that would be disastrous for the economy. So that's why the Federal Reserve is like, we need to lower inflation or else we're going to have some serious problems. And so far it's been working kind of good. We can say that. Like the good is that inflation appears to have peaked and it has been downtrending. So for example, we can see in June, inflation peaked at 9.1%. Ever since that, we've been seeing it slowly drop off month after month after month. That's awesome. But at the same time, even though inflation is downtrending, we're still seeing 7.7% inflation. Like, that is not good. Like, the goal is to have like 2 to 2.5% inflation. So 7.7%, while it's good that it's downtrending, it's still way too high, and it definitely needs to fall down soon. Because if we go to like a 25-year chart of this, we can see we're still way above the levels we really should be at. So it's like give and take, but at the same time, the Federal Reserve, they're trying to lower inflation, obviously. So what do? They increase interest rates. But if they increase interest rates too much, then basically we will have a nasty recession. So the Federal Reserve is trying to balance lowering inflation without destroying the economy with crazy high interest rates. And that's the big you could say the hardest problem going on in the economy right now. So we could see this is the Fed funds rate. This is the rate that the Federal Reserve has been raising. Back in like 2021 and ever since COVID, this rate has been at basically 0%. And that's why we saw the unlimited money party in the stock market and everything else over the past couple of years. But that is now over, right? Because we have interest rates on the rise, and they've been on the rise very quickly. And with that has come some unforeseen consequences, you could say. So normally what you see in terms of interest rates, so we're looking at like a U.S. Treasury bond yield curve right now. This is like, I'll explain it in like a simple way. Basically, you can buy any type of treasury. You can buy a treasury that expires in a month from now, 3 months from now, or 30 years from now. Common sense would tell you, no one knows, no one can predict the future 100% perfectly. But it's easier to predict the future, let's say a month out, rather than 30 years out, right? Like, nobody knows what's going to happen in 30 years from now. No one knows, right? But while no one could also predict what's going to happen in a month from now, it's easier to judge the risk, and you'll have a better sense of what's most likely to happen in the short term rather than the long term. So what that means for bonds and yields is that shorter term yields or bonds pay a lower percent interest. So basically, let's say for a 1-year treasury a year ago, you might get 0.27% interest per year, right? In a 20-year treasury, you might get 2% interest per year, right? You get less interest for giving your money to the government for 1 year rather than 20 years. And these are on annualized terms. But the main thing you need to know is that the shorter duration you give your money to the government, the lower percent yield you will get. Here's where everything gets whack. So basically, we are seeing the exact opposite in the yield curve right now, and this is bad because almost every single time this has happened, we've seen a recession shortly afterwards. So now what's happening in the market is you can give your money to the government on like a 1-year treasury, and you can get a 4.7% interest rate, and you can give your money to the government for 10 years, and your interest rate will only be 3.5%. So it's like, that is a big problem. Like, it really should not be this way, and it's very rare for this to happen, but when it does happen, we almost always see a recession afterwards. Like, think about that. 1-year treasury, you get 4.7% interest, and then 10-year treasury, you only get 3.5% interest. Like I said, these terms are annualized, so, like, if you give your money to the government for 10 years, you're going to get more money at the end of it. But in terms of the rate you will get a lot higher interest rate now on the shorter duration bonds than the longer duration bonds, and that's whack. So basically what we're looking at now is the 10-year, 2-year treasury yield curve, right? Basically, you take the 10-year treasury and you subtract the 2-year treasury from it. This should always be positive because, just like I showed you in the first example, you should get a higher percent interest rate on the 10-year rather than the 2-year because there's more risk involved, at least theoretically speaking. But now it's the exact opposite, like I was just saying. And we can see every single time, basically every single time throughout history, that the yield curve inverted, we've seen a recession afterwards. So we can see very early 80s, we saw 2 recessions, yield curve was inverted. You could say early 90s, yield curve inverted, recession a couple months after. We had another yield curve inversion in June of 2000. Recession happened shortly after. We saw another yield curve in December of 2006. So recession shortly afterwards. We even saw a yield curve inversion in 2019, and then we had COVID, and that was a recession as well. Now we're seeing a gigantic yield curve. What's going to happen next? Of course, no one knows 100% certainty, but looking throughout the past, we've seen a recession almost every time. So that's not good. But another important thing to keep in mind is that if you go back through the technical definition of a recession, when you have 2 quarters of declining GDP, then technically we've already had a recession, but some people change the definition of that. So another important thing to keep in mind is, depending on who you ask, we are technically already in a recession. So you have to keep that in mind as well. And also, by the time that, let's say, the White House announces that we are in a recession, it might be already halfway through or over with at that point. So don't just think that because we have a good chance of having a recession, that does not necessarily equate to the bottom of the stock market. It's totally possible for us to have a recession and the stock market it's totally possible for us to have a recession in the future, but also at the same time have the stock market bottom before the recession term was officially announced. So the bottom could be in before a recession is actually announced. So definitely keep that in mind because the stock market is very forward-looking and it likes to price things in. So very important that you keep that in mind. But looking back throughout history, this signal has definitely not been a good one, and it's just whack. You know what I mean? It's just whack whenever we have yield curve inversions. So now looking more at the yields themselves, basically what we see on the chart right now, we have the 3-month treasury, we have the 1-year treasury, 2-year, 5-year, 10-year, and 30-year treasury. Basically, all of the yields for these bonds have been exploding this year. That's why you see mortgage rates that have basically doubled, and you see interest rates all across the board rising at a crazy pace, right? Treasuries are doing the same thing. Now, the thing is, when you have treasuries rising so much, that affects a lot of things, from whether it be the mortgage interest rates or even the valuations of the stock market overall. So looking at these yields, ideally we would like to see them either flatline or start to come down a little bit. We've started to see some of the, I guess you could say, longer end of the curve, so like the 10-year and 30-year yields start to fall a little bit, but we're still seeing some of the shorter duration yields, like the 1-year and 2-year, hold up a lot better. So we want to see this either go sideways or go down, because that will just be good for the market overall. So keep that in mind, because when you have yields moving this high this quickly, it has a very important impact on everything from, like I said, mortgage rates to the valuations of all stocks out there and a lot of other things. So keep that in mind. So that's very important. Another important thing to keep in mind is that in the same way that not all stocks are created equally in the S&P 500, not all stocks in the entire market are created equally either. So we can see year to date, we've seen basically all industries red, or all sectors red, except for one, and that's the energy sector. So we could see basically any stock you pick has been struggling this year, or in like a good scenario, it's just flat. But if you're holding any like energy stock, whether it be ExxonMobil, Chevron, OXY, or anything like that, odds are you've done pretty well. Now, while this is good to realize, it's also very important to keep in mind that the stock market constantly goes in cycles and rotations. So like, we might have energy stocks really outperform for a year, but then the next year they might significantly underperform. So basically what you can do is keep that in mind and say, you know what, if we see energy stocks are really leading the market right now, there's a good chance that they might just underperform in the future, because it's very rare to see like one sector just like completely dominate like year after year after year after year. Everything goes in rotations and cycles because that's just how the market works. It's just very cyclical, right? So when you're looking in the market right now, when you see some of the stocks that are significantly underperforming, those might be the best stocks to scoop up rather than the high-flying stocks that are already up a ton. So what I'm saying is, if we're looking at the stock market right now and you don't know, and you're looking at it and you're a little bit confused as to what might happen in the future and you're just uncertain, you're better off buying quality companies that are already low and at their 52-week lows, rather than buying stocks that are basically at multi-year highs, hoping that those same stocks will continue to lead. It will be much more beneficial to scoop up the stocks that are low right now and that have the fear in them, rather than buying stocks that are already up. You know what I mean? So just the main caveat to that is you have to make sure the companies you're buying are quality companies. Don't just buy any stock because it's down, just because it's at its lows. That's also very important to keep in mind. Another thing I want to talk about, while we do have some historic things happening in the stock market and the bond market right now, it's also important to keep in mind the events that we have going forward. So for December of 2022, we do have a couple important events that are on the schedule. So for December 9th, we have PPI data, inflation data. This is always important. We also have a Michigan consumer sentiment preliminary reading on that same Friday. These are important, but the more important events definitely come in on the week, or I guess you could say these two main days, December 13th and December 14th. On December 13th, we have the inflation rate. This is so important because it tells us if inflation is actually continuously falling, and then depending on that reading, it will influence everything from how the feds increase their feds funds rate, to how the yield curve adjusts, to how treasuries move, to even how the market overall moves. So December 13th will be so important, and there will be a lot of volatility coming in on that day. And then right after that, on December 14th, we have Jerome Powell set to speak at his FOMC interest rate event. Basically, the Feds are going to increase interest rates yet again. Right now, they are expected to increase interest rates by 0.5%. Over the past couple of meetings, they've been increasing interest rates by 0.75%. So the rate at which rates are increased is starting to slow down, which is a good thing. However, if inflation comes in bad, meaning very high, then we might see a 0.75% interest rate hike rather than a 0.5% interest rate hike, and that would be a bad sign because we need to see inflation start to come down soon and consistently. So keep that in mind. And then those are like the two main events for the rest of the year. We do have some retail sales and personal income and personal spending towards the end of the month. But, December 13th and December 14th are like the main days to watch. They're going to be absolutely crazy. But all in all, it's very historic and rare to see yield curves like this. Like I said, this is the first time we're seeing a yield curve inversion between the 10-year and 2-year Treasury to this magnitude in over 40 years. Like, you look at that yield curve right now it's minus 0.81. We haven't seen that since the 80s. So it has been quite the year, and the volatility is not going to slow down anytime soon. there's going to be a lot of crazy movement throughout the next couple months. So definitely buckle your seatbelts. It's going to be crazy. Also, I want to say, if you learned something from this video, make sure to subscribe. I post all the time, and if you subscribe, you'll see my videos more often. But I also want to highly recommend watching this video on the screen right now. It goes over some of the best stocks to look for the market going forward. Not all stocks are created equally. In the video above, I show you how to find the stocks that are set to do a lot better than others. So definitely watch it out. It's pretty awesome.